Okay, as I said, we're going to cover the banking industry structure and competition. I'm going to turn off the webcam, and hopefully the whole screen will appear. Probably not, but here goes. Okay. So, as I said, we're going to talk about the banking industry, its structure and competition. This is chapter 19 from Mishkin and Eakin, Financial Markets and Institutions. Today, there are about 6,000 commercial banks in the U.S., and that's less than half of what there were a little bit after World War II. But even with that decrease in the amount of commercial banks, the U.S. still has many more banks per capita than pretty much any other country in the world, and many more banks than any country in the world. Partly because we have a lot of rural banks, a lot of small banks. And your book asks if it's better. Well, it's always going to be a matter of opinion. So we have to ask, why did the U.S. banking system develop this way? Does it mean there's more competition? Not necessarily, but possibly. So what we're going to cover today is the history of the banking system and its development. We're going to talk about financial innovation and the growth of the shadow banking system. These are other institutions that make loans, provide financing, but aren't banks. We're going to talk about the structure of the U.S. banking industry. And remember, a bank, by definition, is considered an institution that accepts deposits and makes loans. If it does one or the other, it's not considered a bank. If it doesn't do both. We're going to talk about bank consolidation. As I said, in the U.S., the number of banks has decreased by half, but we still have many more banks than any other country. And we're going to talk about the start of nationwide banking, which is really only 20 years old in the United States. We're going to talk about the separation of banks and other financial institutions. We're going to talk about the thrift industry. This is savings and loans and mutual savings banks and credit unions. And we're going to finish off with international banking. Okay. So in the United States, right, the banking industry started in 1782. With the charter of the first bank, or the Bank of North America. This was the United States' first central bank. And basically, its charter lasted until Congress decided not to renew it. And that wasn't too long after it started. Basically, in the United States, there was a distrust of central banks. So here we had the first bank of North America, 1782, just after or about the time the United States won its war of independence with Britain. Then they chartered the Bank of the United States, and that lasted, for 20 years, until 1811, when Congress didn't renew its charter. It just allowed it to lapse. 5 years later, Congress chartered another bank, the Second Bank of the United States, in 1816, and that lasted until 1832, when, in this case, Congress actually approved the charter, or approved rechartering the Second National Bank, but the president at the time, Andrew Jackson, vetoed that legislation. So it lapsed. So from 1832 to 1863, the United States didn't have a central bank that, to issue currency or anybody else to issue currency. Basically, in here, we had banks issuing banknotes that were used as money, but there really wasn't a national currency per se. In 1863, during the Civil War, when basically only the northern states were voting in Congress, they passed the National Bank Act of 1863, which started the Office of the Comptroller of Currency, basically allowing the United States to have an official currency. Now, obviously, it had official currencies on and off, and it needed that official currency to finance the war. Just like the South had their own currency too. But banks were still issuing their banknotes that were used as money in many places. And from 1832 until 1913, the United States did not have a central bank. In 1913, the Federal Reserve Act was created. And we talked about this during the chapter of the Federal Reserve. We also saw that video, that YouTube video, which showed some of the problems they had in creating the Federal Reserve, the central bank, between basically the banking crisis and about 7 years earlier, and all the negotiation that went into creating the Federal Reserve, including creating 12 district regional banks. Then from 1913 to 1933, right in here was the Great Depression, there started being more national legislation of relating to the financial system, and also more important or more encompassing regulation. So we had the Glass-Steagall Act of 1933 and 1935. This was only 1933. It created the FDIC, the Federal Deposit Insurance Corporation, and it separated out commercial banks from the security industry. In other words, it didn't allow banks to underwrite. Banks couldn't sell stocks and bonds even for their clients. In general, there were some loopholes that people figured out later on, or bankers figured out later on. But for the most part, they couldn't sell securities. They also can't hold private debt as part of their assets. When I say private debt, private bonds, corporate bonds, nor can they hold common stock or any other type of stock. Okay. So after 1933, remember there was other legislation that we talked about, but the one that repealed Glass-Steagall was Gramm-Leach-Bliley in 1999, where commercial banks were now allowed to sell stocks. Now, supposedly, the underwriting part of the bank, that means where they sell stocks, they can write insurance contracts, etc., are separate from the banking part of the bank. Now that's supposed to give us some stability to the banking system. Whether it does or not is a matter of debate. Okay. So for each bank today, there are at least 3 agencies that can regulate them. There's the Federal Reserve, there's the Federal Deposit Insurance Corporation, that insures pretty much all banks and most thrifts. There's the Office of the Comptroller of Currency, as I said, was created in 1863, as we saw. So if you're a national bank, those three entities right there uh, will be your regulators, can regulate you. If you're a state bank, well, the Office of the Comptroller of Currency doesn't have much regulation over you, but the state will be your third regulatory body. Of course, excuse me, there's other types of depository institutions like credit unions uh, that are regulated uh, by the Federal Reserve, Office of the Comptroller of Currency in some cases. Uh, but for the most part, they're regulated by separate agencies. For instance, credit unions are regulated by uh, the National Credit Union Insurance Corporation and the National Credit Union Administrative Board. I might have that title a little wrong, but the point is that they're regulated separately. But they're not banks per se, and also thrifts. Thrifts are going to be regulated by the Federal Reserve. Some will be regulated by the FDIC, and all the thrifts have their licenses locally, so they'll have local regulation at the state level. Okay. A few times the Treasury has proposed legislation to centralize regulation. In other words, uh, consolidate the regulatory bodies uh, into one, but it's never survived Congress. Uh, it might be a good idea to have fewer regulators, but it might be nice also to have at least two. Uh, that way, any undue influence that a bank or bankers might have in one regulatory body may not transfer to the other. For instance, if I have an independent Federal Reserve along with the FDIC, and those are the only two regulators, well, if banks are able to control the FDIC, well, we still have the Fed and vice versa. Uh, but four probably aren't necessary. In most of what the Office of the Comptroller of Currency does is redundant. Uh, in recent years, uh, right, the traditional banking business of making loans that are funded by deposits have declined, and some of this has been replaced by the shadow banking system. It's easier for larger corporations now to issue bonds, corporate paper. It's also easier for finance companies to issue corporate paper and then make loans to businesses. Uh, we also have the big investment banks like Goldman Sachs that's providing liquidity to many businesses today. And that basically is taking business away from banks. So how have the bank responded? Well, they responded to this uh, changes in demand conditions. They also replies changes in supply conditions, people not depositing their money. And finally, changes or trying to get around regulation. All of these things can be addressed with financial innovation. Some are good, right? Demand and supply conditions. Avoiding regulation probably isn't a good thing for the health of the banking system because those regulations are put in place for a reason uh, to help the stability of the banking system. And if you get around them, well, or if you try to get around them, well, uh, you're basically uh, defeating the purpose of the regulation. You're you're adding instability to the system. Okay, so we're going to start with the demand conditions. Uh, in the 1960s, there was a huge increase in interest rate risk for the banks. Uh, Interest rates became a little more volatile. And one of the responses was adjustable rate mortgages. Before that, Since the Great Depression up until the 1960s, all mortgages were fixed rate mortgages. Well, they started adjustable rate mortgages where usually locked in a low rate for a small period of time, uh, maybe 2 to 5 years. And then the rest of the mortgage, the interest rate would change according to market conditions from that point on. So if interest rates were high, adjustable rate mortgages are probably pretty attractive to consumers. That way you could lock in a low rate for now and hope that in the future interest rates would decrease. Banks also started using derivatives to hedge risk. Derivatives are derived from the underlying asset, in this case, future contracts. Now, you could have a future contract on treasury bonds, and with that, you could hedge interest rate risk. If interest rates go up, uh, you could either go short, where you could go short on these treasury bonds, and that would hedge or that would offset any losses that you might have on your assets from those increasing interest rates, and vice versa. Uh, there's also options. All of these were traded on the Chicago Board of Trade. Uh, and in the 60s, well, more of these contracts became available, more of these derivatives became available. Supply conditions. This is major changements in improvements in information technology. In improvements in information technology, they lowered the cost of financial transactions, making it profitable for financial institutions to create new financial products and services. And they made it easier for investors to acquire information about uh, the securities they're investing in. Uh, you could look at their balance sheet quicker, you could look at their accounting statements quicker, and you can figure out basically the health, or you can get an idea about the health of a company a lot faster because of technology. One of the things that this helped with, these technological improvements, were the birth of credit cards, and we'll talk about that a little later. Actually, we'll talk about it now. Before World War II, credit cards existed, but they were basically lines of credit at department stores, right? So you could get a card, but you could only use it at one store. Now, this was good for the company. It sold more because of having these credit cards, and basically it earned interest off those credit card loans. And it was fairly safe because you knew the client, or you knew the clients, and there wasn't a big problem with fraud. But because nationally, credit cards might not, or financial companies may not know all their clients or have a good idea of who their clients were, uh, this was something that was hard to do at a national rate. But in 1960, with the advent of computers, new technology, uh, that created the possibility of national credit cards, and hence Visa, MasterCard, and American Express isn't a credit card, but the bank card that doesn't really make loans, but uh, well, doesn't make interest loans, but it allows you to buy stuff for a fee. Okay, so, and you had to pay it off that month. So with Visa and MasterCard back then, for those of you who are old enough, back then, the way you buy something is you'd give them your credit card. They'd place it on a uh, mechanical apparatus on top of paper. They'd run it, and basically it would indent with carbon paper on 3 copies. And basically the store would keep a copy, the the customer would keep a copy and they'd send a copy to Visa or MasterCard to get paid. They also had books that they put out that they sent out every week that had the number of stolen credit cards. So that way, if somebody came with a credit card, you look at the number, look it up in the book, and you'd see if it was stolen or not. Obviously, today with electronic payments, that's a lot easier. And now, of course, the success of credit cards and those national credit card system of Visa and MasterCard, we're allowed debit cards. Therefore, if I have a checking account, I don't have to write a check everywhere. I can pay with my debit card, much in the same way I would pay with a credit card. There are also automatic teller machines. Here we call them ATHs, a todas horas, with automatic teller machines, ATMs. This is basically an electronic teller where you could go and you can perform almost every transaction you could perform with a human. You could take out money, you could deposit money, you could check your account. You can do a lot of those things that bank tellers did historically. So all these things, the ATMs, the internet, telephone technology helped banks provide better service to their customers. Now today, there's actually virtual banks that don't have buildings. Where you deposit your money electronically, you can only take out your money at ATMs, but you can't go to a building and talk to a teller. So the question your book ends, will virtual banks on the internet become the primary form of bank business? And up to this point, customers have been reluctant. There's not a lot of growth in these internet-only banks because depositors want to be able to go in and talk to somebody face to face. And they probably aren't very confident in the security of these banks and their ability to get hacked, because we see it on the news all the time. And it's always nice that if there's a problem, you can go into the bank and talk to somebody. For instance, if I lose my debit card, I can go directly to the bank and get a new one. Whereas I'm only internet bank, I have to have that bank delivered to me, usually by the mail, which takes a little bit longer. Okay, like I said, there's still these problems with internet security. People really aren't confident in these all online banks, even though most people with checking accounts do at least perform part of their banking services online. And that if you're going to buy a CD or something, you'd like somebody there face to face to explain basically what the product is, something that isn't always possible on the internet. Some of you, for instance, right now might prefer me giving a lecture in class to this one. Some of you guys might prefer this, but for the most part, banking customers want that face-to-face interaction, at least in the United States. And of course, technology isn't perfect. Development of computer systems and the internet has made electronic payment more cost effective. For instance, I probably write 3 or 4 checks a year. I don't know, before I probably wrote 1 or 2 a month. Well, 20 years ago when I graduated from graduate school, I probably wrote 1 a month. Now I probably don't write more than 2 or 3 a year. In Europe, however, people are more accepting of e-banking technology. In the U.S., I think this data is a little old, but uh, at least about 10 years ago, the U.S. wrote 10 billion checks a year. In Europe, about two-thirds of the non-cash transactions, in other words, if you're going to pay for something, you don't write a check, you do it electronically. Uh, Europeans have had hero payments for decades. You go to the bank or post office and you transfer funds uh, electronically. And they talk, and your book talks about Scandinavians, and they're a much bigger user of this mobile technology. It asks why. I don't know why, but my guess is it's cold up there, and people don't want to go outside. They'd rather do these transactions from home uh, without having to go outside and freeze. But there might be other reasons. Uh, America using checks or paper checks are costly, and your book asks, can it be changed? And even in the U.S. is changing. It's slow, but it's steady. Electronic money. This is money stored in cash that only exists in electronic form. But at least in the United States, most of this is representative of actual dollars. There's also the cryptocurrency market, which is money, uh, fiat money that's not backed by anything, but is essentially an electronic payment system where people have confidence that other people are going to accept the cryptocurrency. The difference is between our fiat money and that Bitcoin is the government passes laws that we need to accept cash, US dollars, where Bitcoin and other cryptocurrencies don't have that. So this e-cash, as I said, most of it uh, represents actual dollars, is basically an account on some servers that you use to make purchases. Now, prediction of this cashless society has been going around for a while. Basically, when I was sitting where you guys are sitting, my professor talked about the possibility of a cashless society. That's 30 years ago. And we still have cash, and cash is still pretty important, although it becomes less important, slightly less important every day. But it doesn't look like it's going away. Okay, for a couple reasons. One is not all places have the ability to accept e-money, even though it's getting more popular here. In Puerto Rico, Banco Popular uh, started a new payment system, and for the life of me, I can't remember it right now. Where you can transfer money back and forth, and you can transfer money to businesses and buy stuff. Uh, and there's always that security and privacy concerns of money. You may not want the government to know how you're spending your money for different reasons. Maybe it's because you're uh, engaged in criminal activity, or just because you don't want your privacy violated by the government. Uh, Maybe you have somebody, an ex-wife, for instance, that's looking into your finances. Well, in that case, you might want to have your money in cash uh, and not have a record of it electronically. Again, these things aren't always ethical or legal, but it is a reason why people, in a lot of cases, or in some cases, prefer cash to electronic payments. Other financial innovations. Uh, Basically, computers started allowing for less than credit-worthy institutions to issue bonds. In other words, it allowed junk bonds to be issued. Before 1980, junk bonds weren't issued. People simply wouldn't buy them. Uh, and if there was a junk bond, it was not issued as a junk bond. It was issued as an investment grade bond, whose company uh, fell on hard times and whose financial excuse me, financial situation had worsened. Those were the only junk bonds prior to 1980. After 1980, these risky companies started issuing bonds and people started buying them. Uh, this guy, Michael Milken, was basically the innovator of this. Uh, and he started issuing uh, junk bonds uh, in the primary market. And these guys, basically, as your book says, almost single-handedly created the market. Uh, of course, they ended up in jail for insider trading. Commercial paper, you guys know what commercial paper is. Commercial paper is short-term corporate debt or corporate bonds issued by companies, usually traded in the money market, which means they're less than 1 year, but for the most part, these have maturities of less than 9 months, 270 days. In 2015, there was over $1 trillion of outstanding debt in the commercial paper market. Uh, and the development of these money market mutual funds. Remember, money market is the trading of those securities with less than 1 year to maturity. So money market mutual funds are simply mutual funds that invest in these money market instruments, and mainly T-bills issued by the Treasury and corporate paper issued by corporations. We've talked about securitization. This was basically grouping different assets together and then selling parts of those assets, which in general were illiquid in the secondary market. It started mainly with mortgages, right? Uh, and those mortgage-backed securities were sold in the secondary market and later created problems because banks started liking the profits they were making from them and looked to increase the volume of those mortgage-backed securities, or those mortgages they were making. So they started making more and more mortgages until they ran out of credit-worthy people to make mortgages to, or who wanted mortgages. So they started making riskier mortgages, and then sold them in the secondary market through securitization. Now, securitization was possible because of technology, computers, where you could where you could group a portfolio together and keep track of all the mortgages at once through computers, where before that just wasn't possible. They can do the same thing with other types of loans. You can do it with credit card debt. You can do it with student loans debt. You can do it with car loans. If you have a student loan, more than likely, you took out that loan through a bank, and then that bank, in most cases, took that student loan, which was guaranteed by the government, securitized it, and then sold it, or sold it directly to another uh, bank. Now, for the mortgage market, there were a couple of government agencies, or three government agencies: Freddie Mac, Fannie Mae, and Ginnie Mae, that basically have the function of ensuring that the secondary market for these mortgages is stable and exists. Sallie Mae is the institution that does that for student loans. Now, the securitization, right, is the fundamental building block of the shadow banking system. I don't know uh, if I would agree with that statement, but it is a huge part of the shadow banking system. In traditional banking, one entity engages in the process of asset transformation. This is, I take those loans and I transfer them into another type of asset. And securitization is one way to do that. Uh, it's a process of asset transformation that involves different financial institutions. Usually it starts with the bank and savings and loan. They group some loans together or possibly just sell it one at a time. They group the loans together and they sell it in the secondary market. Uh, that does two things for the banks. One is after it makes a loan, uh, it can sell that loan and then automatically have the liquidity to make another loan. It also gives them or grants them a way to make profits off servicing the loans, i.e., collecting those payments, uh, collecting the payments, uh, and the fees that go with servicing that loan. Uh, and because of that, they had huge incentive to securitize these loans, especially mortgage loans. So here we have an example. We have a mortgage broker, the loan originator. He's going to arrange a residential mortgage, right, funded by a loan servicer. Now, this guy's not a bank. Uh, he is part of the shadow banking system because he's not accepting deposits. So the servicer tells the mortgage to bundle, uh, sells the mortgage. I'm sorry, sells the mortgage to a bundler who bundles these mortgages and sells them. He takes the monthly payments on a portfolio of mortgages and then passes them through, pays them out to those people who invested in them. The bundler uses a distributor, an investment bank like Goldman Sachs, which will divide the portfolio into standardized amounts to everybody. Now, this would be very difficult without computers. So basically, this is a product of technology. So in this securitization process, right, we have the loan originator, we have the servicing, then we bundle those loans together, and then we distribute the payments of those loans. So it's sometimes called an originate to distribute business model. At each step, somebody makes money off that step in the form of fees. Again, this makes it very attractive to these institutions and gives them an incentive to make more of these products. Again, with that incentive, it sometimes gives them too much of an incentive. And when I say too much of an incentive, it gives them or it gives them the incentive. I was looking for another word. It gives them an incentive to make even more riskier loans, more risky loans. So they start looking for people who would like a mortgage, but who wouldn't qualify normally. Now, obviously, the probability that these people are going to default is greater than those people with good credit. So what that did is it created the subprime mortgage market. In 2000, this is a market for residential mortgages given to the borrowers with poor credit records. Now, the argument was that if I bundle these risky loans together, that if one or two of the loans went bad, it was okay because you had a bunch of loans in the portfolio, and therefore you would eliminate idiosyncratic risks. So you build these portfolios, you lower idiosyncratic risk, and idiosyncratic just means individual risk. In other words, grouping it into a portfolio, you get rid of that risk or you lessen that risk substantially. But what it didn't do is eliminate systematic risk, i.e., when the whole economy goes bad, and a lot of these loans go bad at the same time, then these portfolios, these mortgage-backed securities, become worthless. Well, not necessarily worthless, but are worth only a fraction of their original worth. Uh, and people lose money. And we had the financial crisis of 2007 and 2009, which were uh, started, or which was a result of these subprime mortgages. Okay, actually, we've talked about the financial crisis quite a bit already. Uh, let's talk about other innovation to get around regulation. One is uh, reserve requirements. Uh, Basically, this ends up being a tax, right, on your deposits because this is money you can't loan out and make money off. Well, or make as much money off. Well, people try to figure out a way around this uh, through different mechanisms. One was that securitization. I make a loan and I sell it, and then I make money off the fees. I transfer it to off balance sheet. It doesn't affect my reserves. Uh, but that makes, of course, the bank more risky. One other one was Regulation Q. And remember, Regulation Q existed up until the 80s that put a limit on how much banks could pay on their deposits. Well, banks started doing different things to get around this regulation uh, and attract depositors, which were being taken away from them from money market mutual funds in the 80s when interest rates rose. Uh, so banks started investing in these money market mutual funds or offering these money market mutual funds. Basically, this allows investors access to their funds as a bank savings account, offers high rates that couldn't be offered as a savings account because of Regulation Q, uh, but could pay higher interest rates, even though they weren't insured. But for the most part, they were fairly safe up until 2008. Currently, money market mutual funds have assets of about 2.8 trillion. Uh, Now, your book calls it ironic that the money market mutual funds were almost brought down in 2008 because part of that commercial paper that was being sold in these money market mutual funds were of mortgage-backed securities and collateralized debt obligations of different tranches that were being sold as short-term debt. In other words, you get a portion of the mortgage for a short time and being sold as commercial paper, and these money market mutual funds were investing heavily in them. And when they died, well, the money market mutual funds lost a lot of their assets. And of course, the Federal Reserve had to bail them out. Uh, Another innovation are sweep accounts. Remember, Glass-Steagall restricted banks from paying interest on checking accounts. So in the 80s, banks came up with sweep accounts or now accounts in which during the day, your money would be in a checking account. So if you wrote a check, the funds would be there. But every night, they transfer that money from the checking account into a savings account. And therefore, you could earn money on those savings. And at the same time, write checks. Basically, they transfer one to the other. Now accounts are very similar. Basically, you'd hold a small amount of money in your checking account, a much larger amount of money in your savings account where you'd earn interest. And when you wrote a check, as soon as that check got to your bank, the bank would automatically transfer money from your savings account to your checking account to cover that check. But in the meantime, you would earn interest where it was in your savings account. Okay. Okay. Here we're talking about some of the people that were involved in money market mutual funds in 2000. Bruce Brant, one of the originators of money market mutual funds, told his shareholders in 2008 that the fund was managed on a basis of discipline, focusing, protecting your principal. Discipline, focus on protecting your principal. Of course, a lot of these investments were in those mortgage-backed securities. And a lot of those mortgage-backed securities were issued by a lot of these investment banks. One was Lehman Brothers. And when Lehman Brothers went into bankruptcy in 2008, Bruce's fund had assets from Lehman Brothers of $785 million, which was just a little over 1% of his total assets. But it was enough with other failings to drive his mutual fund into insolvency. Basically, even though that was only 1% from Lehman Brothers, he lost 90% of his assets from one day to the other. And of course, this made it so the Federal Reserve had to step in and insure those assets to stabilize the money market, to stabilize money markets. Now, your book says that the money market mutual fund industry is going to face stiffer regulations after 2008, but it really hasn't. Okay, strips. This is one of those innovations. Remember what a corporate bond is. I'm sorry, corporate bond. What a coupon bond is. Most treasury bonds are coupon bonds. What that means is you buy the bond when it's issued for something close to the face value. It pays you interest every period, every 6 months. And then when it matures, you get your last coupon payment, your last interest payment, plus your principal. That's a coupon bond. So a coupon bond, right? The price of a coupon bond is, I'm sorry, the price of a coupon bond is the payment plus 1 plus the interest rate, plus C over 1 plus the interest rate squared in the second period, and so on till the last period when it matures, where you get that last interest payment, and we take the present value, C over 1 plus I plus N, plus the principal payment, 1 plus I plus N. Right? This is a coupon payment. What a strip does is it takes this part of that bond and separates it out from the principal. It sells this part like a discount bond. Remember a discount bond, you buy it below face value, and then when it matures, you get the face value. So I can sell this part as a discount bond, and then I can sell this part just as a stream of income. That is a strip. I basically take a treasury bond and I strip out the coupon payments and the principal payment, and I separate them and I sell them to different people. Okay, here I have an example of a treasury bond, right? $100,000 treasury bond, or I'm sorry, $1 million treasury bond that pays a 10% coupon payment. So each year you get $100,000 if you owned that treasury bond, right? And of course, the present value would be $1 million. Present value at 10%. Now, what the strip does is instead of paying 10%, it's going to strip out those coupon payments and pay you 9.75. They keep the 0.25% as profit for themselves. So that first coupon payment that they're going to pay you, instead of $100,000, they pay you $91,000. For the second one, they'll pay you $83,000. Now, these strips, I can buy this, I can buy this, or I can buy this as a, as a discount bond. Basically, I can buy any of these interest payments the same way I would buy a discount bond. I pay a certain amount today, and then I get in the future, not $100,000, but $97,500 in the future. So if I want to get it 9 years from now, it'll cost me $43,278 to buy that uh, that $97,500 in 9 years. Sorry. If I want to buy it in 5 years, I pay $62,802, and I'll get $97,500 in 5 years. That's what a strip is. I strip out all of those coupon payments, right? And I sell them individually, or I can sell them as a group. And I can sell that last, uh, excuse me, that last principal payment like a discount bond, or I can sell each one of these individual like a discount bond. So the next thing I want to talk about is getting back to our asset transformation. Again, initiated by innovation, or affected by innovation. And that is that commercial banks as a source of loans has decreased dramatically. 20 years ago, 30 years ago, 40 years ago, especially 40 years ago, 40, 50 years ago after World War II, banks were the primary source of loans for everybody's primary source of funds for most small businesses and even for most large businesses. Today, that's no longer the case. So here we see that in the 70s, here in the 60s, basically 30% of loans for businesses and consumers came from banks. That increased to well over 40% in the 70s, and then started to decrease, where in the 90s it was around 20%, and it's a little below that today. And that's because in this time period, we had those money market funds, we had new innovation, new technology that allowed finance companies to come into the market that could raise cash issuing commercial paper or corporate bonds. We had we made it easier for smaller public corporations to issue bonds and cheaper. So therefore, they didn't have to go to the banks anymore. They could go to a finance company, they could issue bonds. And that means that the share of the loans in the economy for banks has decreased. Part of the reason is that the cost advantages of acquiring funds that banks used to have, right, their expertise and liabilities, decreased over time because of technology. It made it easier for people to figure out how risky certain projects were. Also, we had the banking system has regulations. For instance, Regulation Q that doesn't allow them to pay more than a certain interest rate on savings deposits, can't pay money on checking deposits. You had money market mutual funds, which paid more than banks, and you could write checks against them. You could earn interest and write checks, and later on have a debit card. Whereas most checking deposits right now don't earn interest. So checkable deposits fell from 60% of bank liabilities to only 10% in 2016. That's quite a bit. Declines in the income advantage and the uses of funds. Now it's easier to use the securities market to raise funds, i.e. to issue bonds. I can issue commercial paper, right? Whereas only huge corporations could do it before, now smaller corporations can do it. Still got to be pretty big, but smaller public companies can now do it. Riskier companies can now issue bonds. You can issue junk bonds, and of course, securitization. You can group all these loans together that don't necessarily have to come from banks. They can come from finance companies. And those finance companies can group the loans together and sell them, and therefore have more money to loan, and in the meantime, make more off securitization, just like banks. As I said, finance companies are more important because it's now easier for them to raise funds. They can do all these things I talked about up here. They can issue commercial paper, they can issue junk bonds, and then they can sell those. Once they have those funds, they can make loans, and then later on can sell those loans in a secondary market. So what did the banks do in response to this? Well, they lost those cost advantages of raising funds. So they started making riskier loans, i.e., more real estate loans, more commercial real estate loans, and started making riskier mortgages. And they expanded their off balance sheet activities. Regulators in general have expertise in judging the risk of those things on banks' balance sheets, but they have less experience judging those off balance sheet activities, i.e., before 2008, these mortgage backed securities. Now, these create problems for, of course, the regulators who try to regulate these banks. And that's true not only in the US, but in other countries. Now, in the US, right, that decrease in the importance of banks uh, is similar to other countries. Uh, for instance, in Australia, right, banks have lost business to the international security market. In other words, this isn't just companies or Australian companies issuing bonds to make loans, but these are foreign countries in Australia, basically those Asian countries in Japan and Hong Kong, of Japan, and now the Chinese province of Hong Kong, that are important financially in the Pacific Rim. On the Western Pacific Rim, that is. So in a lot of countries, as security markets developed, banks also had to face competition from the new products Social Security offered, just like in the United States. We talked about the number of banks in the United States and how about 2016 there was about 6,000 commercial banks that still existed. And we see the size of those banks. But like I said, after in the 1950s, there was double this. There was 14,000 banks that exist in the United States. So it decreased by more than half. But most of these are fairly small banks that have assets less than $1 billion. You can call these medium-sized banks from 100 million to a billion, but about, I don't know, about 20% of those banks are small banks. Another 40% are medium-sized banks, and then the rest of the banks are big banks. The really big banks, we have about 100 of them, and although they only make up 1.7% of the total number of banks, they hold over 80% of the assets in the banking system. Okay, here we have the 10 largest banks in the United States. We have JP Morgan Chase, Bank of America, and so on. And you can see that of these top 10 banks, they hold 50% of the assets in the banking system, or $8 trillion in assets. Okay. Now I want to jump to restrictions on bankings, or historic restrictions on banking. In 1927, they decided that competition between banks was a bad thing because it encouraged them to take on more risks than they should. So they restricted that competition by not allowing banks to open branches in different states. So one of the innovations that banks came up with were bank holding companies, where a bank holding company wasn't a bank, but bank holding companies own banks. So that same bank holding company can own a bank in one state and can also own a bank in the other state. Now, even though those two banks look similar, they have the same logo, they're owned by the same company, they're not the same bank. So if you had money in one bank in one state, you couldn't go to that same bank or that bank with the same name in another state and take your money out. Later on, you could go to the ATM because they weren't considered branches and take your money out that way. But I couldn't go to inside the bank to a teller and have my money taken out. I because officially it wasn't the same bank. Uh, Later on, the bank holding companies uh, be, became regulated by the Federal Reserve, and it became the dominant structure in the United States for banks. Uh, ATMs, it helped them grow because they weren't considered a branch. So I could have an ATM on my ATM system of all those banks I own in different states. Now, those people, for instance, if Banco Popular had branches in Florida and in Puerto Rico, so in the 1990s, if you had an account here in Puerto Rico, you could go to Florida, or before the 1990s, you can go to Florida and you could take your money out at the ATM and they wouldn't charge you. Uh, they wouldn't charge you a foreign transaction fee. When I say foreign, a foreign ATM, not the same bank. But you couldn't go into that Banco Popular in Florida and take your money out because officially it wasn't the same bank. The number of commercial banks, oh, okay, so that was McFadden Act. This later on, uh, the McFadden Act was repealed. We'll talk about that a little later. But basically, it got repealed after some time. Uh, and part of it was that with the failures of banks in the 1880s, I'm sorry, in the 1980s, 1880s, in the 1980s, and the savings and loan crisis, a lot of these banks that were rescued, the FDIC allowed other banks in other states to buy them out. And basically, one of the incentives to do this for the banks was that they'd have all of a sudden branches in another state that were exempt from the McFadden Act. Uh, Now, that made it very attractive to banks to buy bad banks in other states. If the FDIC or the Fed uh, was the one that was encouraging these sales because it allowed them to get around this regulation. Uh, and then later on, the regulation was rescinded completely. Okay. Uh, the number of commercial banks in the United States was pretty stable. From the Grand Depression, from the Grand Depression, from the Great Depression, up until the mid 80s when we had the savings and loan crisis. Uh, then the number of banks started to decrease. So we see here from basically after the Great Depression to the mid 80s, we had roughly 14,000 banks in the United States. That started to decrease, and now in 2015, we had 6,000 commercial banks. Part of the reason is that we had consolidation during the savings and loan crisis, right? Banks failed. Some basically disappeared, went bankrupt. Others were basically bought out by other banks at the request of regulators. A regulator would take a failed bank, they basically eat the bad assets and sell the rest of the bank to another bank. And this was a way to basically save the assets of the FDIC so they wouldn't have to pay out this huge amount. And the FDIC does that today. About 10 years ago, a little more than 10 years ago, during the last crisis, there were two banks in Puerto Rico, Western Bank and R&G Bank. Both banks were failing, and the FDIC stepped in, took those banks, wrote off the bad assets, and sold those banks to other banks in Puerto Rico. Western Bank was bought out by Banco Popular, and R&G, I think, was bought out by First Bank, but now I can't remember. I'd have to go back and look it up. But it was bought by another Puerto Rican bank. Okay, so that was part of consolidation. And why do we have this consolidation? One is loophole mining. Uh, it reduced the effectiveness of banking restrictions, i.e., one of them was regulations, but i.e., loopholes where I could do different things in different banks at different states, like ATMs, was one loophole. And this development of these super regional banks that had basically ATMs in different states, and those different states allowed these banks to operate across state lines. In other words, although officially they weren't a bank, the state itself allowed the banks to uh, basically perform the same functions from depositors outside that bank or outside that state that they did in other states. Basically, it was different states getting together and deciding that we're going to be one system where banks can operate across state lines. That, of course, was contrary to the McFadden Act. Also, economies of scale, right? Bigger banks tend to be more efficient as far as costs go. They have economies of scale, especially with technology. That increased technology, the bigger you are, well, the more you can invest in that computer and internet technology. Scope economies, remember, scope economies is where I can have different uh, different costs effects. Where if I do everything in the same place, so if I'm a big bank, I can have everything in one place. I can right use data for pricing. I can process that data in a central location with different people. That have expertise in one area, uh, and they can basically use that expertise to help me in other areas. Uh, that's economies of scope. For instance, uh, they don't have them here, but in Puerto Rico, like Best Buys and CompUSA and these big uh, electronic stores tend to build their stores next to each other. And that's economies of scope. Even though they're competing with each other, when they build next to each other, when people come, they'll compare and shop the two stores, and in general, they get increases in sales for both stores than if they were located farther apart, because they have those same customers going to the same place, uh, and including other places. It's also led to what they call complex banking organizations or large complex banking organizations. These are those big super banks that can provide everything, not just banking services, but underwriting services, insurance services, etc. Uh, we talked about credit cards. Now, credit cards like Visa and MasterCard wouldn't be possible without the improvements in technologies in the 60s and then today with computers. Remember, a credit card, even though the payment system is through Visa or MasterCard, credit cards are issued by financial institutions, other financial institutions, generally banks. So if you have a credit card, basically that credit card gives you a line of credit from a bank where I can take out a loan anytime I want. Uh, so I go and I spend money, I buy something with my credit card. I have essentially taken out a loan from that bank at the given interest rate, and I can borrow up to my credit limit. That is my line of credit. Uh, but that money comes from a bank. It doesn't come from Visa or MasterCard. Visa or MasterCard provide the payment service, the system, but that bank provides the loan. Today, 60% of credit cards in the US, right, are held by the five biggest banks. And you remember the five biggest banks. See if I can go back here. Oops, right? JP Morgan, Bank of America, Wells Fargo, Citigroup, and US Bank. I have credit cards from uh, two of those, and then I have one from Capital One. So basically, the large banks hold uh, a large portion of the credit card market of those loans. And that's increased in the last 25 years, right, by 2/3 from 40% to 60%. Custody for the securities for the banks has risen from 40% of assets to 90% today. In other words, now with underwriting, they can hold more of their assets in securities and not loans. And banks, smaller banks, right, just contract with larger banks. In other words, I can deposit my money with larger banks. I can take out loans from larger banks uh, when I need it. I can also do the same with the Federal Reserve. In other words, I can treat those larger banks as small banks, much like a central bank. Okay. Okay. I told you that the McFadden Act was repealed in the 90s, and it was repealed by the Reed-O'Neill Act of 1994. And this basically got rid of the restrictions on interstate banking. Now, banks could open branches in different states. Uh, and of course, it promoted future consolidation. In other words, I'm one bank, I'm one bank. I want to open up in another state. Instead of just having my bank holding company uh, open a different branch in the state, I just buy another bank and change the name over to my name. Uh, okay, so what will the future mean? Well, we'll become more like other countries and we'll have further consolidations. That means fewer banks and a lot more bigger banks or bigger banks, but fewer banks. Uh, but as your book argues, we're going to have several thousand banks, not several hundred. In other words, it might go from 6,000 to 4,000, but it's not going to go down below 1,000. Uh, and about only your book argues that only about half the small banks will remain, and the large banks will double in number. We'll see if that happens. Now, the question is this a good thing or a bad thing? Well, the bad thing about this consolidation is that there is a decline in the amount of small banks. In general, these small banks are supposed to have expertise in their areas. Say a rural bank, maybe an agricultural bank that loans to farmers. They have expertise in helping the farmers out, where a big bank may not have that same expertise. Or if you're in a certain area of the country where a certain type of business tends to thrive or tends to exist, these small banks have expertise in that industry, whereas the big banks probably wouldn't because they have uh, a larger, a larger group of loans or a larger portfolio of loans. Uh, and this rush to consolidation, right? If I buy another bank, well, I have more pressure to make profits because I spent a lot of money to buy that bank, and that might increase risk taking. Uh, the pros, your bank says community banks will survive, and your book is probably right because, as I said, these banks have expertise in certain areas uh, and expertise in local industries. Uh, they'll have increased efficiency. Whether they have increased competition is a matter of opinion. Just because you have bigger banks don't mean they'll compete with each other, or they'll compete with each other more than many small banks would. Much more efficient because they can take advantage of economies of scale and economies of scope. Also, these bigger banks can diversify their loan portfolios better than small banks, which one of the cons up here is that the small banks, right, will stop loaning because they have the excuse me, they have the expertise in certain areas. But that also means that they're going to be less diversified. They're going to be all their loans are going to be in that one area, whereas a big bank will have a much more diversified portfolio of loans. which hopefully will lessen the likelihood of bank failures. Okay. Next, we're going to talk about Glass-Steagall. Remember, Glass-Steagall were basically two legislations passed in 1933 and 1935. And they did the following. They only allowed banks to invest in certain government bonds, municipal bonds, agency bonds, and treasury bonds. They prohibited underwriting, i.e., banks couldn't sell stocks, even just for their clients. They couldn't sell real estate, and they couldn't sell insurance. And it prohibited other financial institutions from acting like banks, i.e., you could make loans or you could accept deposits, but if you weren't a bank, you couldn't do both. And in general, most financial institutions don't accept deposits that aren't banks, because if I accept deposits and I can't loan that money out, there's no point in accepting those deposits because I can't make any money on those deposits. But basically, the regulators with time were allowing banks to do stuff that was basically illegal under Glass-Steagall, slowly but surely. They had loopholes. Section 20 of Glass-Steagall allowed certain banks to do certain types of underwriting activities, even though they couldn't be part of the banking system. They had to be a subsidiary, or part of the bank, they had to be a subsidiary. But more and more banks were doing it. So that brought Gramm-Leach-Bliley, which was 20 years ago, which essentially eliminated the part of Glass-Steagall that separated underwriting activities from banking activities. Although it's technically separate now, because the banking activities are insured by the FDIC, where those underwriting activities aren't. In the state banks, right, the states retain insurance regulations. So if the bank's going to sell insurance, it basically has to be approved by the state, and all the underwriting activity is going to be regulated by the SEC. Now, these won't be regulated by the Fed in general, or by the Office of the Comptroller of Currency, or by the FDIC. So the Office of the Comptroller of Currency regulates the subsidiaries that underwrite the securities, but they don't regulate the actual underwriting. That's the SEC. The Fed still oversees the bank holding companies, which is interesting because bank holding companies came into existence because of the McFadden Act, that they couldn't open branches in new states. But for some reason, bank holding companies is still the prominent structure in the banking industry, even though the reason for their existence isn't there anymore. Okay. I can open up banks in different states. I don't need a bank holding company to do it. So Gramm-Leach-Bliley sped up the consolidation, right? Because now I want to merge. I want to merge with other banks that are selling stocks, because that's a potential profit opportunity. I also have mergers between commercial banks and other financial intermediaries that provide those type of underwriting, either insurance or stocks or real estate. And these mega mergers, right, between different financial institutions are likely to increase in the future, or likely on the way, as your book puts it. And this basically means that banks are going to become larger and more complex. And for the most part, they have in the last 20 years, since Gramm-Leach-Bliley. Okay. What do banking industries look like? What does the banking industry look like in terms of that restriction on other types of financial services? Well, your book has 3 countries. It gives examples. Germany where there's no separation. German banks can do what they want. Uh, they can uh, they can accept deposits. They can sell stocks. They can invest in stocks. They can sell insurance. They can sell real estate, etc. In Great Britain, the UK, uh, banks are allowed to sell stocks. They're allowed to do underwriting. There's no legal separation of subsidiaries. In other words, the bank can do everything. In the United States, right? Well, that banking portion, that deposits, and those loans, well, mainly the deposits are insured by the Federal Deposit Insurance Corporation. So that basically is regulated separately from the underwriting portion. So basically, to do that, the bank has to basically create subsidiaries, right? You'll have the bank, you'll have that portion that does actual banking, you have the portion that sells stocks under a subsidiary, but that portion that sells stocks won't be insured. Only the excuse me, only the banking portion is going to be insured by the FDIC. In Britain, they don't have that separation. They don't need the subsidiaries. Uh, Now, in Britain, like the United States, uh, the banks can buy and sell stocks for their clients, but they can't own stocks as part of their assets. In the United States, banks can't hold stocks either. All they can hold are government issued security, usually treasury bonds, but also agency bonds and municipal bonds. Uh, my understanding is that insurance is allowed by banks in Great Britain, but it's uncommon. They have separate insurance companies, even though by law they're not restricted. And the third country is Japan. Now, this Japan allows their banks to buy stock and hold stocks as part of their assets. Bank holding companies are illegal. Don't know why, but again, since there's no restriction on branching within Japan, not really necessary. And your book argues that they're moving more towards a British system, right, where banks can do everything, but and including owning stocks, where in Britain they cannot, but everything else should be the same. Okay. The next thing I want to talk about is the thrift industry. The thrifts, remember, are these mutual savings banks, savings and loans, credit unions. Uh, so here we have savings and loans, mutual savings banks, credit unions, and wait a minute. We'll start with savings and loans. Savings and loans can be chartered by the federal government or by the states. The Office of the Comptroller of Currency regulates those chartered by the federal government. And those savings and loans are all FDIC insured. They used to be FSLIC insured, Federal Savings and Loans Insurance Corporation. But the FSLIC basically got liquidated and got put under the FDIC. Most are members of the Federal Home Loan Banking System, which is basically an association of savings and loans. Who makes loans to their members? Saving loans, of course, experienced difficulties in the 80s. Now, your book says they engaged in the same activities as commercial banks, which is true. But remember, going into the 1980s, savings and loans were restricted in the types of loans they could make. They could only make real estate and mortgage loans. And their deposits either had to be, what their deposits were by law, almost entirely savings accounts. So they accepted savings accounts, or savings deposits, and they made mortgage loans for the most part. When interest rates rose, that created a problem because they first of all, they had Regulation Q, where they couldn't pay more than 5.25, so they lost a lot of deposits. But their assets were mainly in long-term fixed-rate mortgages, which means that the money they were receiving was far less than what they had to pay out, even at five and a quarter, the maximum amount they could pay. Uh, but even then, people started taking their money out of the deposits with the savings and loan because money market mutual funds were paying much better. So in the 80s, they basically changed that and allowed these savings and loans to basically behave more like banks, having their assets more short term, and hopefully their liabilities more longer term. Uh, and basically, a lot of experts think that there really is no difference between savings and loans and banks anymore. And it doesn't make sense for them to have separate charters. They're basically banks, they're insured by the FDIC. Uh, and even though at first, well, they went from uh, having their assets restricted into mortgages to being more like banks to having their assets restricted again. They're still a lot more like banks than they started off as. Okay. The next are mutual savings banks. These are similar to savings and loans, but like credit unions, are jointly owned by their depositors. They may be subject to FDIC regulations for their for the state chartered banks. Most of these mutual savings banks have their charter locally. Not all the deposits are FDIC insured, even though they're regulated by, or they can be regulated by the FDIC. Most have local insurance funds from the state, and most have assets in excess of $25 million, since the states regulate them liberally. But $25 million really isn't big compared to the banking system. It's fairly small, uh, but big compared to, you know, for instance, credit unions and other smaller savings institutions. Okay, so credit unions. Now we'll talk about credit unions. Uh, Similar to savings and loans, they're organized around a particular group or individual with a common bond. I'm not sure why it says similar to savings and loans, because anybody can deposit on savings and loans and anybody can take out loans on savings and loans. In credit unions, you basically have to be a member of that group. For instance, educators, you have to be associated with education. That sometimes that means a student, sometimes that means teachers working for working as part of the staff at a university or a school system. But you have to be at least loosely associated with that group. And even though with time those groups have, or what's associated with that group has been more liberal, you still have to be part of that group. Where in savings and loans, you don't have to. The National Credit Union Administration issues federal charters and regulates federally chartered savings and loans. Uh, and at least most of the credit unions I'm aware of have federal charters. Uh, Assets for them are generally consumer loans. These are personal loans or auto loans with fairly short maturities, less than 5, 6 years. Uh, Therefore, they don't have a lot of those mortgages, and since they don't have those mortgages, they avoid some of that timing conflict between their assets and the liabilities, having their assets long term and their liability short term. In this case, both are short term. Okay. They're usually small with assets less than $10 million, although there's some fairly big credit unions now. Uh, Regulatory changes have allowed individual credit unions to cater to a more diverse group of people by interpreting the common bond uh, less strict. Uh, I took out a loan from a savings loan called PenFed, uh, and all I had to do was uh, to join a group that supports veterans. Uh, I was in the Marine Corps, but I didn't have to prove I was a veteran. All I had to do is basically join that group, and that allowed me to take out a loan at that credit union. And the interest rate was much lower than any other bank would give me at the time. Uh, Branching across state lines for federal credit unions is liberal, and they can actually branch into other countries. Uh, but in general, when they branch into other countries, these are from the military credit unions, Penn Fed, Navy Federal, these places where they have bases around the world. Well, they open branches in those other countries right next to the base, and they cater mainly uh, to those individuals stationed at that base or employed at that base. Remember, these these bases employ not only the servicemen, but they also employ employees. A lot of federal government employees go overseas to work at these bases, and they also employ locals in these different countries. Uh, okay, so now we're going to talk about international banking. We talked about the similarities of underwriting or the differences in underwriting between the United States and other branches. Right now, there's 100 American banks with branches abroad. Given that there's 6,000 branches, there's not a lot of banks that have international branches. But those branches have a lot of assets, or those 100 companies have a lot of assets, $1.5 trillion in assets. And it's grown quite a bit. 60 years ago, there was only 8 banks that had branches internationally, and they only had $4 billion in assets. Okay. Uh, well, why did they grow so fast? Well, part of it is globalization. The international sector in the United States grew quite a bit. Also, if I open up a branch in another country, uh, regulation or it's unclear who gets to regulate that branch. We talked about the Basel Accord last chapter. But if I can open another branch and I'm not under US regulations in general, other countries have more lax regulations. I can do underwriting in those things. I can make different kinds of loans that I couldn't do in a domestic branch. So I can do stuff in those foreign branches that I can't do in the country. And finally, I can tap into the euro dollar market. I can offer euro dollar accounts. I can pay interest uh, on dollar denominated deposits in other countries and pay the interest rate that those people or expect in that other country. That's usually higher than the U.S., which attracts that money. Uh, but I can also make more on the asset side of the loan side in those foreign branches. So the euro dollar market represents US dollars deposited in banks outside the US. Uh, so these companies that want dollars or they have dollars, they want to earn interest on those dollars. And of course, dollars are used in international trade, but so is the euro and the pound. So dollars held outside the U.S. aren't subject to U.S. regulations. London is a center for the yield dollar market. It sounds like a good test question. So to capture those profits in euro dollar transactions, well, that's what U.S. banks did. They opened branches in Europe, and they started paying interest on dollar denominated accounts abroad. So U.S. banking overseas, most foreign branches are in Latin America, the Far East, the Caribbean, and London. Of course, London because of the euro dollar accounts. And these are for different reasons, either because we trade a lot with those countries or they're financial centers. Uh, in the Caribbean, a lot of these banks help these people, or traditionally help these people avoid taxes. Now, with different laws, that's harder to do. Uh, Another structure is the EDGE Act Corporation. These are corporations that are sub-engaged in international banking. So what this means is the U.S. bank can own controlling interest in foreign banks. In other words, I could buy a foreign bank, I let them run as they usually do, uh, bank or finance company, and this is governed by something called Regulation Q. I'm sorry, Regulation K. Uh, and okay, the next is international banking facilities. The Fed allowed banks to do this in 1981. They accept time deposits from foreign investors. Remember, this is in the US. Sorry, I didn't make that. They're not subject to the return requirements. They're basically treated like an international bank. And these foreign investors cannot conduct business with American businesses. And in general, the states they receive excuse me, they receive local favorable local tax treatments. In other words, they pay less taxes. Okay. So foreign banks in the U.S. hold more than 25% of U.S. banking assets. They do a large proportion of U.S. bank lending, nearly 20%, for lending to U.S. corporations. Now, this is different than those foreign bank holding companies, like, for instance, Santander, which is a Spanish bank, but those branches, right, are subject to all the U.S. regulations and any other bank is in the United States. Uh, so in the U.S., these foreign banks, not like something that are set up as an agency office of a foreign bank. In other words, U.S. bank, they have fewer regulations. A subsidiary of a U.S. bank, in this case, like Santander, uh, they have the same regulations of any other U.S. bank, and they have to basically do all the same things that a U.S. bank has to do. And then finally, a branch of a foreign bank, not an office. Again, this is through the EDGE Act or the International Bank Fund. Wait up, IBFs. Yes, International Bank. Okay, regulations. Actually, you know what? I'm going to clear this up in class. I don't remember what IBF stands for right now, but I promise to clear it up in class on Monday. That's Monday, May 10th. No, May 11th, sorry. Okay. The International Banking Act of 1978, basically it made foreign banks, like Santander, subject to the same regulations as U.S. domestic banks, except that if a bank was already operating in the United States, they were grandfathered in. Okay. Now financial markets are more integrated, so it makes sense that the U.S. has both international banking within its borders from foreign banks, and or U.S. banks operate in different countries. It encouraged bank consolidation abroad, and the importance of foreign banks in international banking has increased. Here I have the largest 10 banks in the world. When I first started teaching this class and the predecessor of this class, which was money and banking, uh, China didn't have but one bank up here, and they were down here below. The big banks were from Japan. Now Japan only has one big bank, uh, Mitsubishi UFK Financial Group, right? But the top The three biggest banks today are Chinese. The fifth biggest bank is Chinese. Right? Only one, oh, I'm sorry, two U.S. banks are here. Again, when I gave this, only one U.S. bank made the list, J.P. Morgan Chase. Today, we have Bank of America that also made the list. For a while, I think Citibank was up there above Bank of America. And of course, the European banks have fallen. We have uh, English Bank, United Kingdom Bank, and then we have a French bank, and we have a German bank that make the top 10. But those big banks are now Chinese. So what did we talk about? We talked about uh, the development of the banking system, the historical development. We talked about uh, the history of the financial system and the central banks and regulation in the U.S. We talked about the growth of the shadow banking system and how those changed both the supply and demand uh, for banking assets and liabilities. And we talked about how the banks or how banks responded to those changes. We talked about the size of the banking system, its character, its structure, and the regulation. We talked about consolidation and the changes in regulation that led to that consolidation and the changes in technology that led to the consolidation. We talked about the separation of financial services from the banking system and how that separation has decreased over years. We talked about the thrift industry, savings and loans, mutual saving banks, and credit unions, and how they're regulated. Now, those are different from banks, even though, like banks, they accept deposits and make loans. And then we talked about the international banking system, and we talked about the difference between international banks. We talked about how U.S. banks operate abroad and how foreign banks operate within the United States. Uh, okay, so uh, that's it for chapter 19. I hope to cover most of this in class. Uh, if I don't, this is why I'm making this non-Socratic lecture, so you guys can see this at your leisure for chapter 3. Okay. If you have any questions on this lecture, you can go ahead and email me, or we can talk when we have our next online meeting.